Well, many world leaders have heaved a sigh of relief over the news that the U.S. president said he would not use military force to take over Greenland, later announcing he had formed a framework of a deal for the Arctic region. Let's get a market reaction to this from Thomas Urano, co-chief investment officer and managing partner at Sage Advisory. Thomas, thanks very much for joining us today. What do you think of what's unfolding right now? Where do you think this is going to end up?
Well, I think the escalation and then subsequent de-escalation of this Greenland negotiation, I think it's definitely having an impact on fixed income investor behavior, right? I say that because when we look at what happened in Treasury space, typically sort of these geopolitical events coincide with this safe haven move towards Treasuries, but that didn't happen. I think what we saw was a jump in Treasury yields of about 10 basis points or so under the threat of tariffs as a negotiating tool in order to adjust or like express interest in Greenland for the U.S. That didn't help Treasuries. In fact, we saw was a rise in yields. Instead, we saw gold jump and the dollar weaken. So I think it's a sign that this pattern of negotiating tactics has a cost when it comes to geopolitical disputes.
And is this a trend that has gone on through other Trump comments and is now starting to kind of solidify more as a reaction?
Sure. I mean, we saw market reactions to Liberation Day. I think the policy of Trump's negotiating tactic, the art of the deal, let's go to an extreme position and then work backwards to somewhere in the middle, find it works. But I think it's having an impact. In fact, we saw an active Treasury divestment from a Denmark pension fund. They said they would sell all their U.S. Treasuries. It was about $100 million. Small scale, but more symbolic as a policy bias away from Treasury and away from U.S. assets. So, at the end of the day, I understand that, geopolitical disputes take time to sort out. It's a negotiation, but I think there's some unintended consequences in terms of behavior patterns by investors. It impacts credit supply. It can impact borrowing costs.
And how are you approaching this then?
Well, as domestic investors, we're cognizant of what a widespread revolt against Treasuries would be, and more so from a policy standpoint. From an investment standpoint, politically, that's a risk. But internally here in the U.S., we're still comfortable with Treasuries. We're comfortable with the level of rates. We think that the sideways pattern in rates that we've seen for the last year probably continues through most of this year. There's question marks about how, what policies the Fed will pursue in the first 6 months of this year under the remainder of the Powell regime. And then what does a new Fed chair bring to the mix when the administration nominates this new chair come June?
Okay. And one of the things everybody's talked about is rate cuts. What kind of an impact do you see that having then for bonds?
Sure. So, I think rate cuts for the most part are priced in. I don't know that that creates a huge tailwind for the bond market. I think the market is priced appropriately for, let's say, 2 more cuts. I think one of the risks is that this new Fed chair comes in and the economy is doing well, right? The labor market's doing fine. Inflation remains mildly above target range. It may be a little more difficult for a new Fed chair to persuade the entirety of the members to agree and vote for further cuts in the second half of this year. So I think that's a mild risk that's priced in. What's the scenario or what happens to the bond market in that type of scenario? Maybe the front end of the curve has to reprice some of the rate cuts that it's priced in thus far. But in general, our view is that we have a stability of yields here. Just remember, 10-year yields for the last year have been somewhere in the 4 1/8 to 4 1/4 range. We think we kind of continue that ballpark so long as inflation kind of remains subdued and the labor market remains kind of in this low growth, low higher phase.
And Kuzma, you talk about geopolitical events. What is there any has that been factored in? If it got torn up, as Trump has said, the negotiations are going to start later this year. What kind of a factor is that?
Yeah, I think if we revert back to changes in tariffs, tariff policy, if the U.S. Supreme Court rules against the IEEPA tariffs, they have to come back with a new form of tariffs and redo the negotiation process. I think it just adds a layer of geopolitical uncertainty that the market may have to price in or think about, what that means in terms of level of rates. We've seen a number of people talk about the term structure of interest rates, geopolitical events, and thinking about rates being slightly higher or steeper curve, it really kind of embeds this idea of further inflation risk and fiscal risk. And I think that's one of the issues that the bond market is dealing with. And ultimately, in reality, the bond market, I think, is kind of driving back the idea of fiscal sustainability. If you think about what higher yields means and steeper curves mean, it means that an interest expense becomes a real issue again.
And just want to get your thoughts before we go on Japan and what's unfolding there.
Yeah, so this is a great example of what I'm talking about here, is that in Japan, we have a new prime minister. She's working on a package of tax cuts and spending in order to stimulate an economy in an environment where inflation's already running at an elevated level. In response, we saw 30-year JGBs up 140 basis points in the last year, right? So that's a significant sign, again, where the idea of the bond market vigilantes are coming back. They're kind of exerting their influence and saying, hey, unlimited spending that's debt financed, driving large fiscal deficits, that's just not on the menu anymore. So I think there's a cost to this type of policy, of tax cuts, deficit spending, stimulating. And in a world, again, where we don't have zero interest rates, we don't have negative interest rates, central banks, by and large, have kind of halted the QE process. This free money environment is over. Okay. And I think fiscal policy has to take that into account.
All right, we have to wrap it up there. But Thomas, thank you, as always, for joining us.
Appreciate it. Thank you.
Thomas Urano is Co-Chief Investment Officer and Managing Partner at Sage Advisory.